with the down payment to buy a house can be a really big hurdle. That's a lot of money to save up. And it doesn't help that you might have seen chatter online saying, oh, you've got to make a 20% down payment, or, oh no, don't do that. Put down the bare minimum. So we are going to break it down and talk about why it might be smart to make a larger down payment. Before we get into all that, how much is actually required? Well, it varies depending on what kind of home loan you're using. If you're getting a loan through the Department of Veterans Affairs or the U.S. Department of Agriculture, you might not be required to make a down payment at all. If you've got a conventional loan, which by a landslide is the most popular type of mortgage, depending on your qualifications, your down payment could be as low as 3%. If your mortgage is backed by the Federal Housing Administration, it varies depending on your credit score, but you could potentially make a down payment as low as 3.5%. Jumbo loans, which as the name implies, are larger, also tend to require larger down payments. It varies by lender, but they might ask you for as much as 10%. So if none of these loans actually require you to put 20% down, why is 20% such a big deal? The number seems to stick out in people's minds because that's where, if you're using a conventional loan, you no longer have to pay private mortgage insurance. 20% is the threshold where lenders consider you to have enough equity, that they're confident that you're good for it, everything's okay, and you're going to repay the loan. But overall, the idea that you have to put down 20% is a myth. Looking at data from April 2022, 44% of all homebuyers made a down payment that was less than 20%. If you pull out just the numbers for first-time homebuyers, it's 67%. So fully 2/3 of first-timers made a down payment that was below 20%. Those numbers are lower than they were in April 2021, when half of all homebuyers made down payments below 20%, and 71% of first-timers put down less than 20%. Clearly, people are making smaller down payments, but how much are they actually putting down? Looking at some numbers for all of 2021, the median down payment was 13%. First-time homebuyers made smaller down payments with a median down payment of 7%. And for a lot of people, making a smaller down payment is really the only realistic option for becoming a homeowner, and that's totally fine. Whether it's because you live in an extremely high-cost area or you have a lower income, if you need to make a smaller down payment in order to become a homeowner, you do you. You're still on that journey. You're still earning equity. You're still getting all the benefits of being a property owner. You just made a lower down payment, and that's totally no big deal. Also, say you do have a lot saved up, but you maybe don't want to use all of it on the down payment. For example, if you're buying a house that's going to need some work, it's totally okay to make a smaller down payment and set some cash aside for the stuff that you know you need to do. The one thing that you do want to be really cautious about when you're doing this kind of budgeting is to make sure that because you're making a smaller down payment, you aren't borrowing so much that you're ending up house poor. That means that you're spending more of your money each month on simply paying your mortgage than on other stuff that you need to get done. Those are the pluses of a smaller down payment, but why might you want to make a bigger down payment? Particularly in this market, making a larger down payment can be an advantage. One reason is because even though you aren't giving the seller money any earlier, and you also aren't making a different offer in terms of the total price, seeing that you're making a larger down payment makes the seller feel more confident, and it can feel sort of more like cash in hand to them. So even though it doesn't actually change things, it just gives them that cash vibe, and sellers really like that, especially in a market where there are a lot of buyers offering to pay all cash. So the sort of more that you're able to offer upfront, the better you can sometimes look to sellers. It also shows sellers that you're on solid financial footing, which can be a concern if they're thinking that you might need to cover an appraisal gap. An appraisal gap is something that happens when your lender asks for an appraisal. So they basically have a third party look at comparable sales and try to assess the value of the home you're buying. If they do that and the appraised value comes in at less than what you've offered, you could then be stuck having to make up the difference. Now you might be wondering, okay, wait, I've heard that this is a wild market. There are people making all these offers. They're throwing tons of money around. Why would that even happen? It's because in a lot of places, home values have increased so rapidly that appraisers who are trying to look at comparable sales and are maybe looking at data that's a few months old, they can't even keep up with it. In a market that was more friendly to buyers, you'd probably negotiate with the seller to either have them come down to the appraised value or like at least meet you halfway. But in the current market, a lot of times buyers are left to make up that difference because your lender is not going to let you borrow more than they believe the home is worth. So if you had that larger amount saved for a down payment, you can take some of it, cover the appraisal gap, and still make a down payment. It'll just be a little bit smaller. Another advantage of making a larger down payment, particularly one that's around 20% or higher, is that because lenders like that security of that 80% loan to value ratio, you might be offered a better mortgage interest rate. That certainly never hurts in a rising rates environment. In general, because with a larger down payment, you're borrowing less money, that means that your monthly mortgage payments are going to be smaller because it's little chunks of a smaller amount. And also, you'll pay less over the life of the loan because even if your interest rate is higher, you are accruing interest on a smaller amount of money. Given all of that, how do you decide how much down payment to make? We give this advice pretty often, but it's really up to you, your financial circumstances, and also your money goals. You need to balance what you want now in this moment with thinking about the long term. Your goal might be to get into a house as soon as possible, but think about your long-term finances and also if there are other changes that you think you might be making down the line, whether it's expanding your family, going back to school, any kind of shift that you might be making. One thing that you can do when you're trying to figure out how a different down payment would work for you, head to nerdwallet.com, use our down payment calculator, and you can run different scenarios of if you put 3% down, this is the monthly payment you'd be looking at, versus if you put 10% down, this is what you'd be looking at. If overall you're just not sure how you'll save up this kind of money, definitely look into first-time homebuyer assistance programs from your state or even your county or city. These often offer low-interest loans or even grants, aka free money, to help you make your down payment. And remember that the down payment isn't the only startup cost to buying a house. There's also closing costs, moving, furniture, and you don't want to spend every last dime you have on your down payment because after closing day, you're going to want to be able to enjoy living in your new place. I'm Kate Wood, and I write about mortgages and home buying for NerdWallet. If you learned something today, be sure to check out our other videos. We cover a lot of topics related to home buying, including a recent one that we've got about mortgage rates. And while you're here, like this video and subscribe to our channel.